Hello, and thank you for joining us today for our panel on brine and hard rock lithium sources. Before we begin, I'd like to just deal with some necessary compliance language. Members of the media and the press are not authorized to participate in this event. If you're from the media or the press, please disconnect from the call now. The content presented on this conference call is proprietary to and/or subject to the copyrights, Jefferies or third parties. You may not publish or otherwise publicly disclose the name of or otherwise identify the speakers unless Jefferies permits it in writing. By attending this event, you agree to all of these restrictions. So my name is Lawrence Alexander. I'm with the Jefferies Chemicals team. I'd like to first introduce our speakers. We have Joe Walsh, who is the managing director at Lopitiko. We have Farhad Abbasov, who is the president and CEO at Millennial Lithium. Keith Phillips, president and CEO at Piedmont Lithium, and Waldo Perez, who is the CEO of Neo Lithium. I'd like to first start, if you could all just quickly introduce your companies to the audience, and then we'll start into some questions on the status of the lithium industry. And maybe, Joe, if you wouldn't mind beginning.
Okay, thank you, Lawrence, and good afternoon, good evening, good morning, everybody. Lopitiko is an ASX-listed lithium development company. We've been listed since 2016. And we've got a number of proprietary process technologies that allow us to produce lithium and other high-value chemicals from lithium mica and lithium phosphate minerals. So we're looking at an atypical feed source, which gives us, I guess, a point of differentiation, but also we're operating in much less contested space for feed source as a result of that. Since these technologies were first developed initially back in 2013-14. We've progressed them through to successful piloting. We've completed a definitive feasibility study for a vertically integrated project that goes from open pit mine through flotation, conventional flotation, to then chemical conversion using those proprietary technologies to produce high purity lithium hydroxide. And as I say, a range of byproducts as well. So we're now on the cusp of transitioning the project, our phase 1 project, into development. Just the other week, we announced that we've appointed the EPCM contractor, and this week those works have started. So we're actually starting into development in parallel with arranging final offtake arrangements and a full financing solution for the project, with the objective of coming into production in 2023.
And sorry, so Farhad, if you could.
Sure. So Millennial Lithium has been developing one of the large lithium brine projects in Salta province to Argentina for the last 3 years. It's probably one of the most advanced brine projects right now, with the feasibility study completed. We also got our environmental permits. Recently announced also the results of our pilot scale operations or processing plant, whereas we produce basically one of the highest grade lithium carbonate products in the world. During the first trial, 99.96%. The project is also well advanced in terms of infrastructure development and so forth, including the fact that we signed fiscal stability certificate with the government of Argentina. And it's a large project with already proven and probable reserves. So the plan is now to basically complete all these programs by June, July, and then by the end of the year, secure funding for construction. And if that works, we should go straight into construction probably late this year, early next year, and that will put us in production probably in 2023, early 2024.
Okay, great. And Waldo, could you introduce Neo?
Yes, thank you. We are a company that is developing the Treecube project located in Catamarca province. This project is a recent discovery, and in 5 years we have gone from the discovery to completing the discovery of one of the highest grade lithium brine projects in the world. We have signed an agreement with CATL, which is the largest battery manufacturer in the world, who has acquired 8.5% of the company. And together, we are putting together the final feasibility study that is going to be ready in the next month. Within that, we also have a pilot operation that has been running for over 2 years, producing battery-grade lithium carbonate accepted by CATL as the final product for them for over 2 years. Our production is 1 in 600 scale, and the technology to develop the process from the original discovery to final production is completed. This is the 5th largest brine project worldwide, so it's very significant, and it's the 2nd highest grade brine project worldwide with very, very low impurities, which makes that our operational cost and our capital costs of constructions are extremely low, actually defined by Roskilde, like the lowest in the world. So it's a very significant lithium project.
And Keith?
Thanks, Lawrence, and thanks for having us. So Piedmont Lithium is, as of last week, an American company. We were founded by an Australian group. We re-domiciled last week and are now an American company. So we're one of 3 American lithium companies, Albemarle and Livent being the other 2. And we're very proud of that. We're developing a large lithium hydroxide project in North Carolina, about 30 miles west of Charlotte. And it'll be an integrated spodumene to hydroxide project. So we have the only spodumene deposit in the U.S. is the Carolina Tin Spodumene Belt, which is quite large. It's about 30 miles west of Charlotte, surrounded by fantastic infrastructure, low energy costs, great transport, customers, et cetera. And we intend to, and I should say the Carolina Tin Spodumene Belt was the source of virtually all the world's lithium from the 1950s to the 1980s. So it's a great time for us to be operating and building a project here. We will produce lithium hydroxide here in North Carolina for the U.S. market. And from a timing perspective, we've been working on this project for about 5 years. I joined the company 4 years ago. We published a pre-feasibility study last May. We'll publish a definitive feasibility study later this year, September, October timeframe. We will publish an updated kind of interim scoping update in the next couple weeks, because we've materially enlarged our mineral resources through drilling. So the numbers the market is focused on are a little out of date. So there'll be some fresh numbers coming out in the next week or 2, which we think might see a quite significant improvement. So we're looking forward to that and looking forward to this discussion.
Okay, great. So let's start off with, I think, the perennial sort of debate, the supply-demand balance. And I think right now, people are sort of expecting tight conditions for several years as the industry sort of catches up to the demand curve. How do you see this flowing through into the types of partner discussions or the shifts in contract terms that you're just seeing now compared to, say, 3-6 months ago? Just trying to give a sense for like how the temperature is changing or has changed.
Well, I can mention about our discussions with the CATL, which is the largest battery manufacturer in the world. And my senses are that very clearly everybody is getting concerned about supply, very clearly. Not only from the side of our partners, but from the side of other people, shall I say, unrequested solicitors that are actually knocking the door. So there is very clear, in my mind, a sense of urgency for OEMs and also battery manufacturers and also cathode manufacturers to secure product. We have close contacts with some people that is actually buying lithium carbonate and lithium hydroxide in the market for different reasons, polishing and processing and so on. And the market is extremely tight. And even the prices are even higher than the prices that are usually commented into, shall I say, places where you can see the lithium pricing. Okay? So when you actually go to buy and you are in a rush and you need it, the prices are not even those, are much higher than those. So this is what I can comment about that.
And then for maybe Farhad or Keith, if you could touch on when you have projects that are in early stages, are people coming to you with different types of structures or proposals to try and lock in supply for far longer durations?
Yeah.
Go ahead, Farhad.
You want to go ahead?
I'll start. So we've been working for 3 or 4 years with the largest lithium consumers, car companies, battery companies, cathode companies, some trading companies, and have built really good dialogue. I think I would agree with Waldo that the sense of urgency is building. I will say, to be candid, there was no sense of urgency maybe a year or so ago. I think there's a lot more clarity now, where you have the biggest automotive companies in the world fully committed to electrification, partnering with, you saw the Ford and SK announcement last week. And now I guess a Stellantis and Foxconn announcement might be coming. There's a real focus that it's one thing to design an electric vehicle and maybe build one. It's another thing to find the materials to fuel it, the battery materials, et cetera. So I think there's a real sense of urgency. For our part, we have strong dialogue with just about everybody we would think of as a priority customer. We think we're aided by the fact that we'll be producing hydroxide in North Carolina, which certain people will want, we think. And we think that might be unique. But we do need to raise capital to build our project. We will be commencing a strategic process here soon with financial advisors. We've been approached by a number of parties, from car companies, battery companies, cathode companies, but also oil companies, chemical companies, mining companies, private equity groups. I think there's a lot of interest in the sector. It's hard to find businesses with 20% top line growth for 2 decades ahead and potentially very strong margins. So we're basically holding off on offtake conversations now. We continue to have the dialogue. We're not interested in having conversations about short-term, about contracts right now, because frankly, we're waiting to see whether one or more of the potential customers might show up with meaningful capital on a basis that's attractive to us. So that's something that we'll be evaluating.
Yeah, just to add to that, I mean, what we've seen in the last 6 months is that interest has peaked, not only from within the industry or from within the battery chain, but also from outside the industry. So there are a lot of energy companies from oil and gas and some energy sectors as well, actually showing a lot more interest. And I think they see this paradigm shift in the industry, and they really want to get foothold in the industry, in the sector, in the lithium sector per se. And some of the players have never been in upstream production. I mean, they're looking into that as well. As far as offtakes are concerned, we've been in talks with several groups, but frankly, for us, an offtake is not just a way to sell the product. That is another source of capital for us. So we're very selective in who we talk to. In other words, we're talking to literally 2-3 groups out of Europe and out of the US. And these are the groups who are either willing to invest directly in the project or the company, or they can bring substantial debt capital through their respective Exim banks. We're at the stage where obviously we need to secure significant funding for construction. And for us to sign an offtake just for the sake of an offtake doesn't really make much of a sense at this point. In terms of the structure of offtakes, really, we're not trying to kind of cap them in any way possible. We're basically doing it index price. We are negotiating potential floor price just to make sure that in case of a catastrophe, we don't have to produce and sell the product at a loss. But in terms of upside, we keep it completely open. And current potential off-takers are in discussions with us, quite happy with that. So we think in the next few weeks and months that we will see interesting developments in the industry in general. And I hope that Millennial will join the fray in that regard as well, probably in summer, where we'll see some significant developments and certain milestones set and hit by quite a few players, I suppose. And you've seen already, some of the consolidation taking place in Orocobre with Galaxy and so forth. And I think that's just the start of the entire trend.
Great. And so, Joe, can you give your perspective on non-traditional sources of lithium, the challenges, if any, of getting accepted in the marketplace, whether because of differences in contamination, difference in process, difference in co-products, just what challenges you've seen. And given the prospect, should we expect sort of that the door is now open for non-traditional sources in a way that maybe wasn't true 2-3 years ago?
Yeah, thanks, Lawrence. I think that 3 or 4 years ago, the door was open. And what we saw at the beginning of 2018, when we saw peak prices for the last cycle, and then what really went into what's been a 3-year bear market, is we continued to have engagement with all sorts of groups downstream, as Keith alluded to. That engaged, but how meaningful was that engagement? And I don't think that was specifically related to process technology or anything like that. It was just a condition within the industry. And we started to see that change in the second half of last year, and it's really gained momentum into this year. And so I absolutely agree with what Waldo was saying at the beginning of this session with regard, but I think that was specific to China. And if you think about the Chinese companies tend to require lithium carbonate because they tend to rely on an LFP cathode chemistry. What we've seen happen in the last 6 to 9 months, and really Tesla started this with their battery day in September, and then VW, I think, really enhanced the message in Power Day in March, is that OEMs are starting to look at mixed cathode strategies. And what that means is they're going to be looking at consuming both lithium carbonate and lithium hydroxide. Okay, and the challenge then for the cathode manufacturer or the OEM is to predict, not necessarily this year or next year, but 2, 3, 4 years' time, exactly what proportions of carbonate and hydroxide they might want or might need. And so one of the things that was coming out of the discussions we've been having, particularly over the last year, is the requirement for flexibility between hydroxide and carbonate. And so earlier this year, we came up with a process step that allows us to quite elegantly convert lithium hydroxide, which is our base product, into lithium carbonate. And both of those products will have an industry-low CO2 footprint and greenhouse gas footprint. So what I think some of these drivers are is it's less a focus on technology. When we take groups involved anywhere really within the supply chain through our pilot plant, the nature of the conversations change. There's suddenly a much better understanding and appreciation for the process, the fact that there's no pyrometallurgical requirement, the fact that there's no, it's all atmospheric pressure, there's no pressure vessels, and there's a series of chemical steps, and it comes down to elegant chemistry. And once that's understood, I think it really breaks the back of that perception about new technology. And so that then allows us to go to the next step. And it really does start to become largely environmental considerations around particularly CO2 footprint, discussions about water usage, land intensity usage, etc. And those are the elements that I think are putting pressure on particularly European and North American investors or stakeholders in the supply chain, and less so in Asia. And so I think that we've found that we've largely been able to break through those elements associated with technology.
And actually, I guess with respect to the pressures on the stakeholders, can we talk a little bit about the shifting political landscape? So I think there's two sides to this. One is the US, the new administration, the degree to which they are supporting the industry. And maybe Keith, if you'd like to touch on that. And then Waldo, if you wouldn't mind touching on sort of some perspective on what's happening in Latin America and the relative attractiveness of Chilean and Argentinian projects. We've seen sort of political shifts in both of those countries in the last few years. So some perspective there would be helpful as well.
Sure. So I'll start. I mean, there's an article in the press today, I forget the source, talking about the Biden administration looking offshore for raw materials because, for whatever reason, which is interesting. I view that as great news for us. So I'll kind of give you the background. The Trump administration was very pro critical material mining, critical mineral mining, which is helpful. But they weren't particularly interested in incentivizing EV production or EV adoption or infrastructure spending. The Biden administration is generally has become pro critical material mining as well, and is very ambitious with respect to EV subsidies, EV charging infrastructure, et cetera. That will be kind of great for the U.S., I believe, and I think a lot of that will get passed through legislation. But the news today that, say, the Biden administration is looking overseas, that's not inconsistent with what the Trump administration did. There were discussions with Australia and Chile and Quebec and other parts of the world. The reality is it's highly unlikely that the U.S. will be able to produce enough critical materials for its needs. We're unlikely to be able to produce certainly enough nickel or cobalt or manganese or graphite. We may or may not be able to produce enough lithium. I think what's important from my perspective, anybody who can produce lithium in the United States is going to be in a catbird seat and be in a very special position. We're going to be, we think, a very low cost, sustainable supplier to this market, potentially also to the EU market. And we think we'll have real scarcity value where people will just be unable to get enough lithium from the US. So it's not that we can't produce any, it's just that there won't be enough of us to produce enough. And those of us that are left, I think, I was asked today by an investor on a one-on-one about regional premium pricing. I know Galaxy included some reference to regional pricing in their PEA on James Bay. We have a scoping update coming. We're not going to incorporate a regional pricing premium, but frankly, I fully expect there will be one. I think when push comes to shove, if a cathode plant in Tennessee can get material from China or North Carolina, they're going to pay more for the North Carolina material. So I think that'll be there. So yeah, from a U.S. perspective, I think government, we're generally kind of behind, certainly what the EU has done and what China has done. But I think with the Biden administration, we're catching up. Some states are quite aggressive as well. And I think the U.S., it's interesting. People always talk about how the U.S. is a laggard, but yet, Tesla's American. And you look at all the different, the tens of billions of capital that's been invested in the electric vehicle space, broadly defined, in the U.S. capital market in the last year or so. That's not happening at the same scale anywhere else in the world. It's really happening here. So I think, and the Biden administration's activities will be helpful to that.
Okay. Following the question about politics and Chile and Argentina, the South American producers, historically, Chile has been a country that has been very favorable for mining. But regretfully, in terms of lithium, that's not exactly the case. There is a restricted law that requires government participation for any lithium project, which makes new projects very difficult to overcome. As a result of that, Chile have not seen any increase in their resource or reserves of lithium for literally 20 years, not significant increase. Nowadays, Argentina hosts more resource and reserves of lithium than Chile, which is surprising. This is a result of the work of people like Farad in Millennial, us, and others that have discovered, developed new resources. Some mines are in construction, some projects are more advanced than others, but Argentina has been really the top country in terms of growing source of lithium, actually even at worldwide scale. It's true that there has been changes in government, and Argentina is going through a very, very difficult economic moment and pandemic moment too. Right now, in the middle of the winter, Argentina is heading the cases of COVID worldwide per 100,000 inhabitants. So very difficult situation. However, the government have not done anything against or anything that have been complicating the life of lithium miners and miners in general. Has been extremely supportive, both at local government, and it's critical to explain that in Argentina, mining is controlled by local government, by provinces. Provinces like Salta, where Farad is, or ourselves in Catamarca, they are pro-mining provinces. and they control environmental impact report, royalties, and all the permits. And that's why they are, fully permitted. And even more, Argentina has a mining law that allows you to have tax stability for 30 years. That's something unheard of in many other places of the world. And we also have that. So I would say that Argentina is having political struggles and economic struggles as a result of many issues that have nothing to do with mining. However, I think that there is nowadays a general, shall I say, political agreement in Argentina and in all the parts, the left, the right, that mining is necessary, that should not be, killed or overtaxed or anything like that. And I would say that for the last 20 years, mining has been business as usual, with the exception of some provinces that don't like mining. But this is not our case. This is not the case where lithium is located. So it's a different story.
Yeah, just to add to Waldo's words, interestingly enough, as the macroeconomic situation in Argentina has been deteriorating, even the new government, which is, as you know, left of the center, has been throwing a lot of support behind oil and gas and mining specifically, because these are the industry sectors that would generate hard currency for the economy. And in the last, a year and a half probably since the new president came to power, has been going out both domestically and during his foreign trips, actually fully supporting mining specifically, saying that we'll do everything to attract more foreign direct investment into the sector. Now, to that tune, they came up with a new legislation. I think it's called investment promotion regime for exports, whereas they basically want to incentivize and promote a lot of investments coming directly into mining, and again, some energy sectors or subsectors as well. And I think that is critical because there have been a lot of doubts about the new government's policies and where exactly they're going to move in terms of mining. But as Waldo says, the critical thing about Argentina is that mining jurisdiction resides at the provincial level, not at the federal level. So you basically have, I would say, several layers of protection for mining operators. One is that you get full support from provincial government through licenses, permits, and so forth. But then also you can sign fiscal stability certificate with the federal government, whereas you fix all your fiscal obligations to the government as of the time you lodge the application. So I think that's very important. It is important for companies at our stage of development, like Waldo's and Millennial, because we do need significant amount of capital right now as we go and basically gear up for construction. So it is important to make sure that potential investors understand all these nuances as far as Argentina is concerned.
I think a couple of things to add to that, Lawrence, is I really think that the political inclination to support the broader electric vehicle thematic through that supply chain, I think it's really patchy. So it's a very easy political sell to be talking about supporting electric vehicle sales and electric vehicle adoption, etc. I think that's an easy sell. It's not so easy to be selling mining developments. And one of the things that we very clearly noticed with our upstream assets in Namibia is that we've actually found the best support that we've got there. Like there's local support at a government level and a regional level, but internationally, where we've found the best support is actually from the US government. So we entered into a mandate agreement with the US government's Development Finance Corporation back in October last year, and they're now in confirmatory due diligence looking at providing debt funding to the Namibian part of our development. And it's not easy to get affordable debt funding in this space. And so DFI funding is something that obviously in specific parts of the world where you're eligible for it, that does appear to be forthcoming. But you've got to get the best or have the best environmental and social credentials that really are out there, and you've got to jump through all sorts of hoops to be able to get that kind of level of funding. What we found when it came to considering our chemical plant is that there weren't a lot of incentives in various parts of the world to be building And so, we looked at parts of Australia, we looked at parts of the US, etc. Where we found the best fiscal terms were in an industrial zone in Abu Dhabi. No duties, no corporate tax, an acceptance of technology, affordable power, availability of natural gas, labor force, and local markets for our products. So I think it really is patchy. I think Europe is going to be interesting to see how Europe goes here. They're obviously making great incentives from an EV adoption perspective and encouraging that part of it. It's going to be interesting to see how Europe goes with regard to really attracting the upstream mining piece in its backyard.
And so I want to talk a little bit about cost inflation, and I guess there's a couple of angles on this. One structural and one transitory. On the structural side, the industry seems to be under more pressure in terms of environmental footprint. Sort of, as you say, making sure they have the cleanest credentials possible, and at the same time, the customers appear to be tightening specs. At least we keep hearing this as a complaint, and that tighter specs imply extra processing steps and higher cost. What are you seeing in terms of structural cost inflation? If you think about what you thought of as normalized extraction and conversion costs, say 3-4 years ago, compared to now where you think things are going to end up in the middle of the decade, can you give a sense of how much structural inflation is happening in the industry?
Actually, that's it. Go, Keith. Go.
Yeah, I'll just take a quick crack at it, because I got to first look at our model for our updated scoping study 2 weeks ago, and so it's very fresh in my mind. We had a fresh conversation about capital inflation, and really the good news is I think our study economics. I'm very excited to get the information on the tape. I can't wait. It's going to be, I think, very well received. But there will be some areas of considerable improvement, and there will be some areas where there has been some inflation. And for us, the inflation is going to come down to two issues, both of which you identified, Lawrence. One is environmental. One is, what I think is probably transitory cost inflation, but nonetheless, we're going to have to include it in our scoping study. So there are a number of pieces of equipment, not particularly significant, but individual pieces of equipment where a year ago in our scoping study, we had a bid of 400,000. We now have a bid of 750,000, round numbers. And those things add up, and they're not, and I think most projects that have studies that are more dated will ultimately have to be adjusted to reflect that if they become permanent price changes. We're certainly in a tight market today for a lot of things. So there's no question, if somebody's building today, and you saw Lithium Americas and Ganfeng had in their Kashari project, they had an update of CapEx, and they called it a kind of COVID update. And I think you could argue a lot of the cost inflation that we're talking about now in our project is COVID related. It's really just some markets are very, very tight. All of a sudden, it may not last. Beyond that, we made a decision and made an announcement a few weeks ago that we are going to shift from a kind of conventional diesel truck fleet. We're going to have an open pit quarry, essentially, for our spodumene operation. And rather than having lots and lots of diesel trucks kind of going back and forth, we're going to do in-pit crushing and electric conveying. And that's going to have some operating cost improvements, but it's also going to have a pretty significant environmental enhancement to our project. And that's important to us. But it will require more capital. So our project capital will be inflated to some extent to reflect that. There are some other areas where similar things will happen, where we're going to implement solar on our property in a very material way. And that's going to mean more capital and maybe somewhat lower operating costs. But those are all good trade-offs. We're happy to make them. And one of the challenges, I think, in evaluating, I mean, the 4 projects you're talking about here, it's relatively easy, I guess, to equate, what Farhad and Waldo were doing in Argentina with brine projects. Our project's quite different, say, than Sam's. But anyway, I think what's interesting is all these studies are published at different dates, sometimes months, sometimes years apart, and it's really hard for Wall Street to kind of put them on an apples-to-apples basis. But it's important to try to do it.
Waldo, I think you were.
Yeah, well, we actually focus our design to minimize the two footprints that are the most important, significant environmental footprints that Brine projects produce to the environment, which is CO2 emissions and water consumption. In both fronts, in CO2 emission, relatively easy. We have nearby electricity coming from solar panels that were built by the government, and with extra energy that we can consume, but it won't be enough, and we will be building solar panels to produce almost 100% of the energy of the project out of solar. On top of that, we will we are also focusing on the water consumption. The water consumption of Brine projects has been a source of criticism by some environmental groups. And I don't want to get too much into that because the issues are basically in Chile because they have communities living by the salar. Not our case, literally nobody lives close by. So the issues are not related to that. They are just criticism to the industry by how much fresh water we consume. We actually changed the process and we are consuming half the water, the fresh water that is required by other projects. I need to qualify though that the chemistry of every salar is different and therefore the exact recipe that you use and therefore the freshwater consumption cannot be equal for all projects, okay? In our case, we discover a way to save water and we basically will be consuming half the fresh water that we define in our pre-feasibility study. So this is very good news and a very important aspect of our investment. We are planning to start construction by the end of the year, December, of the evaporation ponds, of the large evaporation ponds, meaning the pre-concentration evaporation ponds. And in that topic, we haven't yet found a significant increase in costs. As a matter of fact, we are in the quotation process right now as we speak, and we haven't found a significant deviation from the previous quotation. So far, so good. However, when we get into the significant quotations of the plant, I'm talking about the lithium carbonate plant, we may have some surprises. So I'm keen to talk with Keith on where were those problems, but we are in the quotation process. So far, we haven't seen it, but doesn't mean that they don't exist. Okay.
Well, maybe one thing I've got to add there, Lawrence, is like, as I said earlier, we're just in the process of kicking off our EPCM contract. So we've recently rerun numbers looking at cost of structural steel, plate steel, etc. Obviously, with iron ore prices over $200 a ton, there's a significant consideration there. And with copper prices where they are on electrical, etc. So we've run some sensitivities, and we're probably looking at this point in time in the 2 to 3% of total capital range on the capex. We're looking at options to be able to try and rein some of that in. Where we've seen, however, and this is Lycopodium's doing the EPCM contract for us, where they're seeing the biggest pressure point is actually in skilled labour. And one of the issues here with, as a result of the pandemic, is mobility of skills has just been paralysed. And so if you look back to 2005, 6, 7, when the industry really had a very significant skill shortage, so I'm talking about the mining and processing industry here, the way that was really dealt with, particularly in Western Australia or in Australia more broadly, was skills were brought in largely from South Africa. Mm-hmm. Well, that is not going to happen today or tomorrow. And so we are seeing significant skills issues in, particularly in Western Australia. I think that they're going to be pockets around the world. Lycopodium has got a subsidiary in South Africa, ADP. They're not seeing those kind of pressures there. And it's that ADP part of their business that's going to be doing the construction management for the Namibian part of the project. So over the course of the last 3 or 4 months in our negotiating this EPCM contract with Lycopodium, all of these things have been very live and present. And so we've managed to work out the best workarounds for them within that contract. Okay, so I think that we will continue to see, again, pockets of cost inflation. How permanent they are remains to be seen. Where our main consumables are sulfuric acid, limestone. Those consumables, we're not seeing any significant pricing pressure on in Abu Dhabi, where we're looking at consuming those. But I guess the one piece of this that I'm looking at where there could be more headwinds is on that skilled labour.
And then I guess just
in closing, I think one thing that first of all, to Joe's point, unfortunately in Salta province, we don't have any shortage of skilled labor, so we're good in that regard. I think the same will for you in Catamarca. But what we did from basically day one for this project was to look at the entirety of this project and how to keep the costs down. And 2 aspects that we really handled or tackled from the beginning. One was where we're going to get our power. As you know, we're at high elevation, and all these lithium projects, lithium brine projects in South America, at a high elevation, infrastructure sometimes is challenged. So we built our own solar power plant. You can see in the background the solar panels. This is the actual picture. And we've been operating that solar plant for the last 18 months without interruption. Has done wonders for us. And Waldo already referred to it, but we are going to now scale it up. So if we had this conversation 2 to 3 years ago, I would have said, Lawrence, you know what? I mean, it is possible, but it's going to be very costly. We're going to probably look into natural gas. But at this stage, the cost of energy storage facilities have come down dramatically. So we can actually scale this up economically. So that would be a huge gain for us on the cost side, on the CapEx side, and on an ongoing basis, of course, for power costs. The other thing that we did here was to keep entire operation, the entire flow sheet, as plain vanilla, as simple and straightforward as possible. And that's what we've proven in the recent pilot scale operations, because that's important, because almost everything that we need for this operation is off the shelf. So when we were getting quotations for our equipment for the processing plant, that was in the middle of COVID, and we didn't see any significant or tangible inflation in costs. Again, we had some, I would say, short-term temporary disruption here and there in terms of supplies, but not cost inflation. But we'll see what happens in the next few years as more and more projects obviously start competing with each other. But at this stage in Argentina, we haven't seen any major change at this point.
And so that touched on something I'd like to maybe just ask all of you just for a closing round of perspective on, is one of the narratives from a few years ago was that there was a demographic bottleneck in the industry, not enough people with experience to handle the number of projects. And the technology steps were not necessarily mature, and therefore high risk of flamboyant destructive events, not just minor issues, but things that would be kind of newspaper worthy. And the number of kind of significant accidents has been a lot lower than I expected. And the industry seems to be doing a lot better job on cost management than I expected. So I'm just curious as to how your perspective on where we are on the maturity curve and where we are in terms of building out the talent to be able to run the units as you scale up. How challenging is it to find or train those people? Because I'm finding that the industry has managed this the last few years better than what I was benchmarking, and so I was curious as to your perspective as to where we go from here.
But Lawrence, I can jump in and go first if you want, just to say that's interesting. I think. We feel fortunate to be in North Carolina, where Albemarle is. Livent has big facilities. There's a lot of lithium processing history. We've picked up a lot of that talent. We just named, as you might have seen, David Klinecki as our chief operating officer. He ran the hard rock business for Albemarle. And so we've been lucky. There's a lot of talent in our area. But importantly, for a number of positions, we've been targeting quite successfully Houston in particular. So I'd say in the U.S., you've got a huge base of talented process engineers, chemical engineers, et cetera, in the energy business, broadly defined. You've got a huge talent pool of coal miners, et cetera, all of whom looking for something more sustainable to do, sustainable in a literal sense for them, i.e. someplace so they can build a career for 10 or 20 or 30 years. So we've been working with recruiters to fill a number of spots, and we've been really excited about the talent. I will say, I think talent is going to become more expensive all around the world, and it's going to be important, but we're focused on it. And again, these are big industries, the energy business in the U.S., the coal business, with lots and lots of talented people who want to find something better to do going forward. So we're capitalizing on that.
I would say that in South America, remember that there is a lot of operating mines like SQM, Livent, that have created, and Albermere have created a body of people. So we were able to secure people without major issues. But I would agree with you that 10 years ago, knowing about lithium brine was very difficult to find. Today, I don't have major issues. You always want to get the best talent, but I don't have major issues with people.
Okay, great.
Yeah,
I'm seeing the little hands show up at the bottom of the screen. So
just Lawrence, to all those words, I mean, we're smack in the middle of lithium triangle. So there's plenty of talent on both sides of the border in Chile and Argentina. So we haven't had any issues with that, knock on wood, so far.
I think what I'd add to that, Lawrence, is I think that one of the things that we're hearing here is there doesn't appear to be a pressure point right now.
Yep.
But if you look at, for example, most commentators' numbers, and I'll just cite BMI as an example, we're going from a circa 350,000 ton a year market to 1 million tons by the middle of the decade, maybe 2 million tons plus by the end of the decade. If the industry is going to bring all of that new capacity on, then it's difficult to see how additional capacity, particularly in the second half of this decade, isn't going to be finding it more challenging to be getting skills. So while there might not be a pressure point right here, right now, or it might be patchy in various parts of the world, it's an enormous task to be trying to meet that kind of demand increase that this industry is trying. It appears to be needing to supply.
So a lot of training to be done, but it's a good problem to have. So thank you very much, everyone, for participating today. Thank you, everybody, for listening in. If you have any follow-up questions for any of us, please get in touch, and we'll make sure we can help connect people if you can't, or if you need any help.
Thank you.
Thank you very much, Lawrence.
Thanks, Lawrence. Thanks, everybody.
Thank you. Bye.